Firstly, thank you so much to IBCA for having this platform for us. And also thank you for having me as your moderator amongst these very, very distinguished individuals that I have actually sharing the stage over here with me. Without any more delay, I'm going to open it up for quick introductions to my fellow panelists. I would love to have you all share your journey and what brought you here to becoming climate funds.
Thank you. Thank you, Karan. I'm Ruchira Shukla and have been on this platform many times before, and many of you know me from my avatar earlier, where I was building out the tech investments business for IFC, which is a division of the World Bank Group. I was with IFC for 12 years and did cross-sector investing. At the time I left my role, that business had 20 direct investments and 10 VC funds, and through those VC funds, 130 indirect investments, resulting in a 150 asset-wide portfolio across South Asia. And I learned a lot of lessons in that journey, building that business. But one thing I saw was that there was a big gap in deep science, deep engineering opportunities in the country, and saw the need for a climate-focused fund that would back deep science ventures. And climate was more a space that had, that had a very, very large problem coming at us at a speed that was unprecedented. Everybody knows that temperatures have been rising. 2024 was the hottest year on record. And a lot has been said about the adverse climate events that have happened. And having worked across all the other sectors, what I began to realize is there is pattern recognition that comes from having invested in other sectors that can be applied to a new sector like climate. But we really need the lessons and the witnesses of the last 2 decades of innovation from India to come and put their minds and their work behind this large problem of climate. And that's what led to the creation of Green Marble Ventures. It's a climate fund, but focused on engineering and science innovations, early stage investments in the climate space to build out leaders from India.
Thank you so much, Ruchira, and you're probably one of the very few people who are sort of have the experience of both hats, so I'm going to lean on that later today. Shishir, do you want to go next?
Sure, thanks, Karan. My name is Shishir Maheshwari. I am a managing director with Eversource Capital. Really started my climate journey with IDFC way back in 2007 when it was not called climate investing. And I've been investing across renewables, and anything related to circularity, etc., etc. In the latest role where I joined Eversource Capital about 5 years back, what Eversource Capital is doing actually is finding the missing middle in the environment space. You see, this space got a whole bunch of startups who are trying to prove business models and technologies, and at the other end, you have very, very mature businesses, for example, renewables, where people are really fighting for yields at different level. But the entire growth space, in this segment across mobility, across circular economy, across new technologies in storage, has not existed, has not survived over the last 15 years or so. And as a result, what we do at Eversource is, we build businesses in this space. This is a fund that we started in 2018. It's the first and probably one of the largest single country focused climate funds across Asia at least. And what we are able to deliver in this fund is to demonstrate to the world that you can really build and scale businesses if you have the conviction around segments. Today we own the largest fleet in electric mobility across the country. Before we sold Ayana, we probably had amongst the largest portfolio across utility and CNI put together in our portfolio. And at the same time, we've done a lot of work around circularity in waste to biogas, waste management, and water management space.
Kavish.
Hey, hi, I'm Kavish. I'm a part of the Multiples private equity team. At Multiples, we've had an exceptional track record in identifying inflection points and focusing our investments around inflection points. We've done this successfully in the digital ecosystem. We've done this successfully in the financial inclusion ecosystem. And I think green investing to us is at that inflection juncture, where in the next couple of years, you will see a large number of extremely large outcomes that will be driven through investments that are climate positive. And that is what we are trying to achieve at Multiples by deploying growth capital in the green investing ecosystem.
Thanks a lot. So one myth that at least you are breaking, which we all want to break, is that climate investing is not just impact. It is actually an economic opportunity. Thank you for bringing that up. Jasjeet.
Absolutely. I'm Jasjeet Mangat with Trifecta Capital. We're a venture debt and financing platform that encompasses venture debt, growth equity, and also a large treasury function. In venture debt, we've deployed $1.2 billion in the Indian market over the last 10 years, over 4 funds, and also extended our reach through work done through the growth equity and treasury functions. I'll just build on the point that Kavish made, which is from Trifecta's perspective as well. Climate is a real business opportunity, a large business opportunity, and it's one that represents a $150 million portfolio for Trifecta, where we've invested in more than 30 of India's leading climate companies in the spaces of mobility, agri-tech, energy systems, sustainable consumer, and there are new areas coming up all the while. There's data centers and so forth that will be supporting a large AI and an ML build-out. And while we can argue about where AI and ML will end and the froth on that market, the assets that are getting generated, especially in terms of the generation of energy, et cetera, are very new. You asked a question, Karan, about the climate journey. It's a journey that started a while back. There's a lot of familiar faces and friends in this room who are veterans of the impact investment space, something that pioneered about 15 years back. D-Light was an example of an early climate investment that was made by Omidyar Network in 2009. And its climate impact has been north of 40 million metric tons of carbon dioxide equivalent, abated primarily by negating the use of things like kerosene lanterns in poor countries like India, and those kerosene lanterns burn and they give off something called carbon black, which is quite negative. But those 41 million metric tons lies in comparison to the annual emissions of greenhouse gases from a reasonable sized country like Kenya or Sri Lanka, which is less than that. So you have a company that is negating or negging out a country. And if we had 40 or 100 D-Lights developed from India and the ecosystem that we have here, so much the better. But that's sort of the broad landscape really, and non-dilutive finance as a tool we feel whose time has come. And it's especially applicable to climate businesses which aren't all bits and bytes businesses, but they are molecules and bytes businesses. And so they're tougher businesses to build up and grow, which so many of my co-panelists are involved in the task of.
Thanks a lot for that. Do you want to go next, Akhil, please?
Thanks, Karan. Hi, I'm Akhil Jain. I represent a fund called Fullerton Fund. We are a Singapore-based investment firm. We've been around as an organization since 2003. We have 2 shareholders today, 51% owned by the Sovereign Wealth Fund of Singapore, which is Temasek, and 49% held by an insurance company called Income Insurance, which is one of the larger insurers in Singapore. We manage about $40 billion of capital, which includes some shareholder capital and third-party money. We are an asset manager. Unlike the sovereign wealth funds, which are Temasek and GIC, we were set up to manage third-party capital. The capital we manage is across different asset classes. It includes fixed income, listed equities, and private equities. On the private side, we are both an LP and a GP. Climate is a very important theme for our organization across asset classes. We have multiple EU SFDR Article 8, which is the Sustainable Finance and Development Regulation. So we have multiple of those funds on the listed equity side as an organization. Those funds require investments to have social and environmental characteristics, but not necessarily decarbonization. just given the opportunity size in the listed side. On the private side, we have a significantly more advanced agenda within climate. We have, on both LP and the GP side, we have been evaluating and making investments in the climate/decarbonization space. I co-lead a fund in the decarbonization space on the GP side, which invests in emerging Asia, which is largely India and Southeast Asia. On the LP side, we invest globally. Just on the topic of this panel and some of the points which were made by my co-panelists earlier about climate being at an inflection point, I would add one of the consistent themes we've realized during our discussions with the LPs is, and I've been investing in climate for 10 plus years in my career, LPs still perceive climate to be a source of financing which needs some concessional capital, or so when we talk to LPs, they are like, oh, I have a climate sleeve and I need to find capital to invest in from my climate sleeve. I think that is changing as we speak, and the time is not far when you don't need climate sleeve from LPs to invest in climate funds. It is becoming more and more mainstream. And happy to talk through more about this.
So Akhil, no, that's a very important point, and I'm glad you brought it up front. I think what would be helpful is maybe from Fullerton's lens, given that you all are GPs and LPs and across asset classes, what is it that has worked for y'all as an asset manager to attract that capital, and could there be some learnings over here for the Indian GPs in this room and on this panel?
So what has worked is, I think when we go out and raise capital for climate, for us, we are an investment firm, first, and when we invest in climate-focused, climate-targeted sectors, we have dual goals. One is meet investment returns and also meet climate goals, right? I think so we are both a top-down and bottom-up investor, more importantly. When we look at opportunities, we look at business models which are built to last, which are scalable, which don't need a certain concessional capital unless it's for a very short period of time. And once we are able to, I think to your question of what has worked, what we are set out to demonstrate through our fund is we can invest capital and generate returns which are commensurate with what sector-agnostic funds generate in the climate space. And increasingly, the funds that we see in the space, whether it's India-focused funds or regional funds, we are seeing proof of that concept. There are funds who have demonstrated that already, and the opportunity size is available to do that.
Ruchira, just on that point that Akhil made, just to come to you, you've sat both like at IFC, and now you also are a GP with your own fund. Just a lot of what we have to do in climate, like you said, is deep tech. And deep tech and hard tech have sort of been themes that are not very well, they don't really get it when we're talking to LPs. They think it's very long gestation. So how is it, or what is it that you are doing in terms of a narrative to change that mindset and actually attract capital?
Very, very important question, Karan. And so I'll echo, before I get into that, what my co-panelists have said, just because I want to make sure it's emphasized enough. And I think we can keep repeating it to make sure the message goes across. Climate is about financial returns. And I want to be loud and clear when I say that I've invested across sectors and I've invested across decades and across geographies. I believe, and strongly so, that climate will out-deliver financial returns bigger than any other sector we've seen thus far. And that's because there are some very important structural advantages to climate tech investing, which other sectors did not have. And that it also ties back to your question about deep tech. When a company has been able to produce a deep science, engineering, IP-based product, it has created for itself a moat that rules out irrational competition. And every sector where VC capital has flown in the past has seen a lot of irrational competition. You talk about e-commerce. Very conveniently, we forget the number of VC funds, the number of startups to which money was invested, and a lot of it was lost. However, the ones that won became leaders in the country, right? Similarly, edutech, fintech, you name any sector, a lot of money went in because a lot of irrational competition came in, and many similar I would say like-minded founders, like-minded VCs tried to back multiple players in the same space. And only one or two could eventually succeed. Climate allows the IP-led businesses to grow in a manner that rules out irrational competition, as a result of which they can get to a break-even point sooner than we have seen in startups in other sectors. And to be able to recognize that early is one of the skills that the VCs of the climate space will need to have, to be able to spot those early winners, back them early, and then shepherd them to success globally. So I think deep tech being seen as, many times they use the term capital inefficient, long gestation. I think the other bit is also about blending different forms of capital. A lot of deep tech gets backed by research grants, government pools of money, philanthropic money early. And let's use the best of that money, but then have practitioners and industry participants shepherd those companies in using that money wisely so that they can grow to become candidates for VC money. And the VC money, when it comes in, can then be catalytic to take that to the next level of growth. So I think it's about mixing stages and capital types depending upon the risk profile of the company as it grows across stages.
And as we talk about mixing capital types, I'm going to go to Jasjeet, given that Trifecta has a very strong debt platform as well as has been equitizing their assets over the last few years. Can you share your learnings in terms of just how Trifecta has navigated this, given that we also have like a few more late-stage investors here who are cash flow, right? We want EBITDA, otherwise we're not investing. So how do you sort of blend these two and also bring in those efficient capital structures, the cross-learnings within the teams to take advantage of these climate opportunities?
No, absolutely. So what I'd say is I'd echo Ruchira's comment, which is that it takes a village to help nurture a sector, a subsector, or an important part of the economy as climate is. Climate's a dual-edged imperative for us. It represents terrific opportunity, of course, as has been described. Also, the impact of not addressing climate is in front of us as soon as we step out our rooms and our cars, etc. So it makes a lot of sense for us to be focused on this opportunity. In terms of non-dilutive capital, it comes in at a point where early stage research grants, proven then by venture models, proven then even by some level of early growth investing, has gotten the core offering of a company or an entrepreneur to a point where she or he is confident about a unit economic, positive, copy and paste model that they want to amplify greatly, right? And the amplification of that model that's taking place is at a high growth rate. It's with a great gross margin. It's great with great consumer or customer stickability. It's addressing important problems, and it does all of those things in order to justify the cost of funds, right? On the benefit side of the equation, the proven entrepreneur who's traveled quite a distance to come from before Ruchira to after Trifecta wants at that point for her or his company to then stabilize in terms of equity dilution and focus on growth, right? But we wouldn't be able to do this if there weren't earlier stages of capital that filtered and weaned out companies to get up to this point. What we give up by being a non-dilutive source of capital is that we'll never have an extravagant rate of return as some of the very top decile or the top 1 or 2% equity funds do. But where non-dilutive capital does come to play is in delivering these mission-oriented metrics, climate metrics, metrics that are important not just from a sector perspective, but from a country perspective or a global perspective. We just concluded a COP meeting in faraway Brazil. So these sorts of financial products help really focus in on those winners that then disproportionately contribute to the positive global climate metrics that are one of two important metrics that we are after, the second one being financial return, so that anyone who's deploying their money in the space gets back a healthy rate of return.
And Shishir, just coming to you, right? I mean, like Eversource is that torchbearer of sorts almost in India for being an early investor in this space. You know, what is it that has worked so well for you all to actually build the institution that you all are today, and what could be the learnings that you would like to share?
I mean, I'll rather echo first what Jasjeet said. It takes a village to really set up these kind of businesses. But the challenge when we started out, there were no people. Forget about the village. There were no businesses actually that you could really invest into in this segment. Therefore, we had to pick and choose the segments, and we decided to build the torchbearers in that particular sector. Take, for example, electric buses. I think government's been trying to run auctions for quite some time, I think since 2016, 2017, but they were not finding anybody. Therefore, and a whole bunch of startups which were trying to validate their technologies, be it motors, be it batteries, be it fast charging, for example, take example, Exponent. They were not able to find a customer who can actually get this done. And that was the whole point of being Eversource. So we were the ones who actually then went ahead and said, we will set this business up. We will set up with the proficiency that India deserves, basis which the whole industry can evolve. And today, if you look at about it, Mr. Kant actually mentioned about it some time back, India will auction so many buses, etc., etc. That's the reason we were the first ones who went to the banks and project financed those buses. Even OEMs have not been able to project finance those buses, right? So we were able to bring all those capabilities together, invested the capital, and essentially that's how the ecosystem got built. What is also important to notice in this is there is a blended capital in our fund that exists. And that goes a long way to attract commercial capital. It's literally like a scaffold. It's like a game of Zynga. You're actually building out, impact capital, grants, blended capital, commercial capital, project finance capital. All of this needs to come in if we have to solve for the multi-trillion dollars that are required to really build these business economically viable and scalable. Without which, the missing middle, which I mentioned out, most of the startups, if they don't find customers like Greencell, they'll never reach there.
And you do all of this in-house, right? You build all these capital stacks in-house.
Yes. That's what we were able to actually pull it together in our first fund.
As startups come to tell us, we have a full stack approach. You are one of those GPs who has a full stack approach.
Generally, I mean, I've been part of this journey even before. In IDFC, we actually started with renewables, and Green Infra was that first company that started that journey where a private equity owned and started company can actually go on and deliver multi-bagger returns and build out for a great time. It's exactly the same thing that we've done here, where you bring in those different roles that you can find from different sectors. And then you bring in the talent and the innovation that exists, right? And that's when you actually take it.
That's great, great. Kavish, like again, multiples, very well-known institution in the private equity space, and like in India. Y'all are now transitioning and, well, not really transitioning, but taking a little bit of a bet on the climate side as well, and you're leading that charge. How is it that y'all are thinking about this move? And I would like you to maybe just speak about more in terms of just, how is it that y'all are thinking about exits because you all have been very successful in also generating exits like out of your portfolio. So how is it that you all are thinking about exits in the climate space?
So, so it's interesting how this journey started for us, right? In sometime in 2022, we said there's a lot of chatter. Let's see what's beneath the hood, and we went down the EV ecosystem. And the more time we spent, the more realization was that this is a commercially large opportunity in India, right? After maybe a year and a half, we deployed about $150 odd million in a single asset called as Montra, which is a subsidiary of Tube Investments, which is a large listed company in India, right? Which is to decarbonize the whole commercial vehicle stack, starting from three-wheelers, going to trucks, tractors, and small commercial vehicles, right? And once you made that investment, you were able to see certain signs as to how adoption curves in this industry play out, right? Just to give perspective to this audience, when we did this investment, we thought the three-wheeler adoption maybe in 2030 would be 30%. In 2025, we've crossed that number, right? So when inflection points hit, the growth is massive, right? The challenge to our minds is not whether this will become large or not, we are very sure. It is how do you convince or how do you define the asset class right to solve for the problem of exits, right? So if you look at infrastructure, people have extremely long hold periods, right? If you look at private equity, the view on hold periods is 5 years. To us, this is an interesting asset class definition where most climate investments will take 7 to 8 years to mature at least, because every climate investment is on a journey close to the inflection point, slightly before the inflection point, slightly after the inflection point, right? So for the business to be commercially viable, it's maybe a 7-8 year journey, right? So if you are extremely focused on 5 years as an exit horizon, it will be tougher. But the moment you start saying that for this investment, my underwritten exit horizon is 7 or 8 years, that problem goes away, right? So we define our exits more sharply to make things happen. I think the second challenge to address is the traditional private equity world does not like investing in assets that have high degree of regulatory dependency, right? This is an ecosystem where even if the commercial viability of a solution is fully proven, you still need some amount of regulatory push to get the adoption curve started. Electric vehicles is a classical case in point, right? There are multiple use cases where TCO always works, but it takes a while for that adoption curve to get started. That's when you need support from FAME, that's when you need support from policy, etc., right? So the more you are able to educate that this asset class will need slightly longer holds, the more you go to institutions that can give you capital to take regulatory risk, right? You can diversify that regulatory risk across different ministries, across different types of regulations and so on and so forth. It will actually unlock the largest chunks of capital. To me, the big unlock is defining the asset class by defining the time period through which exits can happen. And second is finding institutions that allow you to play the regulatory tailwinds that are there rather than push you away from it.
Thanks a lot. Just to go on that point, and I'm going to switch gears up like a little bit like over here, quick rapid fire. One question to all of you all, I want all of you all to answer it, like a couple of questions that I want all of you all to answer, right? What is the one thing that you all think LPs really misunderstand when they think like about climate investments? We talked about it like a little bit like on the panel, but was it one thing, 10 seconds, one answer, one quick answer? Like Akil, maybe we could start with you.
Can I say two things instead of one?
Go ahead.
I think one is returns. In our discussions with the LPs, LPs still have skepticism whether climate can generate the kind of returns which they see in other sectors across geographies. The second thing is also the macro versus the micro, or the top-down versus the bottom-up. It goes back to the point which Ruchira made earlier. It's a sector where the macro stacks up, but getting the micro right, as fund managers, we are looking for high-quality opportunities, business models which can survive for many years, and that's hard. Yeah, I think that's the second point which we feel LPs sometimes take time to understand.
Thanks a lot. Jasit, what's the one thing to your mind that LPs really misunderstand when they think about climate tech?
Well, I mean, for Trifecta, that's a cheat of an answer because people are talking about returns and hold times and gestations being 8 years and so forth. With the venture debt model, you start receiving your first income checks 60 days after your capital is called. And so that provides great for some reason, it provides great psychological freedom to investors coming in, and then they start seeing the principal amount coming back a short period after that. So it's a very regulated set of steps. The more important point that I'll make is that, again, in non-dilutive finance, there's a stack. There's venture debt. There's the concept of growth equity, or growth credit, pardon me, growth credit. And then you get past the balance sheets of companies and you start getting into off-balance sheet financing, securitizing receivables, and so forth. That's a really important and a large and a critical part of climate, which it typically isn't in many other businesses. Think of it as a tremendous positive or a feature of climate investing that other parts of the investing landscape do not have. So there's a great opportunity to play there as well.
For you, Kavish, what's the one thing you think?
Impact and returns don't go hand in hand. I think hopefully this panel can prove it otherwise.
So that's the controversy bomb now on the table. The impact and returns don't go hand in hand. Ruchira, do you want to actually say something about that? Because you actually spoke about impact and returns can go hand in hand.
I am strongly convinced that they do. In fact, I was, at one point I had said that there is no such thing as impact without a return, because impact that does not deliver returns will not be sustainable. So the only way you can sustain long-term impact is if it is return-generating impact. So I'm a strong believer in return-generating impact.
Good,
And
we have two opposing
while I have
views.
the mic, one other thing that I feel LPs do not fully appreciate is the role that India can play in the answer for products, climate technology products from India for the world. India can be the answer of the world's huge dependence on one or two nations when it comes to batteries, magnets, motors, rare earth, you name it. India has the scale, as we heard in the earlier session, and India can be the answer.
To you, Shishir, one thing that LPs don't understand.
I think everybody's talked about returns, so I won't repeat it. But I think the time period to generate that returns is something which is kind of grossly misunderstood across this segment. It's like if you're trying to incubate new models where the entire ecosystem is actually getting built out, it's very hard to predict when the returns are likely to start materializing. And while Jasjeet mentioned about it, but there's only one layer or one stack of capital, but everything below that stack of capital is actually waiting far longer to actually generate the returns. While it's compounding very well, that Ruchira mentioned. However, the time that it takes to compound and the fund life cycles, that needs to be understood very well.
Great, thanks. One last question from my side, well, two, if I have time from the organizers. Quick rapid fire, one word answers, one sector that you'll think is being overfunded, like on the climate side. Ruchira, do you want to go first?
Given the scale of the problem, I would say no sector is being overfunded. I think we just need to do more and more across the board.
Okay, awesome. Shishir.
I don't see overfunding scenario, at least with respect to India. Okay. I think Europe has a different level issues, but India, I don't see actually overfunding scenario.
Same answer.
Same, Jasjeet?
No, same answer. And then, if you look at AI or ML, I mean, there's a big frothiness in global markets. But anything that we do against that will be building out raw infrastructure, RE generations, data centers, etc. And if they don't get used in the first use case, they'll get used in a second or a subsequent use case. So, think of it as a deep ocean and waves on top. The waves on top don't really affect the deep ocean.
Akhil?
Yeah, same on the, I don't think there is overfunding happening in any part of it, but one thing we observe is two sectors, which is renewable energy and electric vehicles, possibly command more than the disproportionate share of discussion when talking about climate investing. There are areas, multiple areas beyond these where there are opportunities to invest, whether it's circular economy, industrial decarbonization, sustainable agriculture.
Thanks a lot. I'll open it up for any audience questions. We can probably take a couple of audience questions. I have the gentleman over here who's put their hands up. Could you please introduce yourself?
Yeah.
Make a question quick and brief.
So my name is Sachin Kumar. I'm the founder of a deep tech company. My question goes to the Jasjeet because he's the only person talking about the AI ML every time. And in last 2 years, 95% of AI startups failed because they were not able to deliver whatever was committed. So what is your take on that?
It's 25 years later, it's .com 1 replicated with its latest avatar. The point was made, you'll have a kill rate that is stupendous in the Western world. You'll have a reasonable kill rate here in India. But coming out of it are going to be the companies that will define the next 25 years. And they'll be foundational, definitional companies to the global economy. So that's the plus minus.
That's not about regional to India, it's across the globe, 95%, and that is a very valid number in all the forums. That's one thing. Second thing, the agentic AI and the Gen AI, which is there in the market right now, what is the security of the data which is getting into that system? For enterprise or any other organization as related to the government or any other sector?
I'm just going to quickly button over here. I want to try and keep the questions more to the theme, which is green investing. and
No.
Perhaps I would encourage you to have this conversation with Jaspreet like offline. Thank you so much for your question, though. Any other questions? Seema, if someone could. Let's just get you like a mic anyway.
All right, that helps. The question for all the GPs looking to fundraise, how do you respond to a situation where everything you said about India being the country that has the solutions, the talent, et cetera, brilliant, but then when you're talking to at least the DFI world, and Richard, I'm not looking at you entirely, Richard, but when we get told, oh, we are over-indexed on India, and this is, or India has its own money, why don't you go raise in India? How do you explain that to the LP world?
Very interesting, because I actually had this question. I want to just add on to that one as well. Are we risk averse? To add to what Seema also said, to her question, are we risk averse from an LP perspective and from a GP perspective? Jaspreet?
Climate is a great place to rebut that point, because I often use this line that if India succeeds in delivering global climate metrics, it doesn't assure us planetary sustainability. But if India fails in delivering its climate metrics, and with pollution the way it is, etc., the planet will surely fail. So, so doing that, there is no amount of allocation or indexation out here that would be quite enough. To the second part of your question, that in fact is part of the market. For example, Trifecta, not to be shilling the firm too much, but our founder Rahul Khanna really, he opened up the market by having a limited partner base be fundamentally from India and from the old Indian business enterprises that are looking to move into the new age. And so we have a large portion of our LP base that is reflected by Indian LPs, whereas we welcome a number of new age LPs. And now we're working our way into DFIs, where IFC's just recently made a large commitment to Trifecta, etc., as we've sharpened out the edges around our impact story and our climate story.
Ruchira, you wanted to say something?
No, I just wanted to add. Look, I think fundraising takes time. I've been an LP before, so I am empathetic to LPs being, I wouldn't say they're risk averse, but they're very mindful of risks. And as GPs are, and now I've also was an IFC GP investing balance sheet capital, and now as a GP on my own, we are custodians of LP capital. So it's a big responsibility to be able to return the money and in the terms and the kind of return expectations they may have. So I think it's just the nature of the market. I think GPs have to try a lot harder, show them the proof points, and then get them over their risk aversion with the actual demonstration that returns can be delivered. And so it is a long road, but that's why we're here.
Does anyone else? Hakal?
Yeah, just in addition to all the points which have been discussed, I would also add it relates to the maturity of India as a private equity ecosystem. I think back in my early days of my career, say late 2000s, early 2000s, LPs were very under-allocated India, but even then the perception was negative on India. And the private equity ecosystem, when you talk to LPs, they would generally not say, oh, I'm over-allocated on North America, right? But why do they say that on India? Because it's the perception of the private equity ecosystem. I think the ecosystem is way more mature than it used to be. And as GPs, obviously, as Ruchira mentioned, it is a responsibility that as the ecosystem matures, we deliver consistent exits, returns, and once LPs have seen multiple of those cycles, those discussions will cease to.
Thank you so much. I think our time is up. Long time back, but my sincere apologies, Rajat. I'm not wearing my glasses, so the time's up. Like actually look like go on some more. Thank you. Thank you, everyone, and thank you to the audience for being here.